So guys, we are back with another round of portfolio reviews, and I am so excited for this one. We've got some very interesting portfolios on deck today. We're going to go under the hood to take a look at each one. We'll check out all the holdings, and I'll give you my honest thoughts on what I like about these portfolios, as well as what I think could be improved. And as we're going through these guys, please keep in mind that I am by no means a professional. These are just my very amateur opinions, so definitely take them with a grain of salt. And remember that at the end of the day, this is all just for fun. Now, real quick, before we get into it, if you want to have your portfolio reviewed by me in one of these videos, just fill out the form I have linked in the description. And also, as we're going through these, leave me a comment below and let me know your thoughts on these portfolios. I'd be very curious to get your feedback on these as well. Now guys, getting into our first portfolio of the day, this one belongs to my friend Colin, who's been investing for somewhere between 1 and 5 years, and Colin has a relatively long time horizon, hoping to live off dividends sometime in the next 2 to 3 decades, and as we can see, Colin is really crushing those contributions. Every single month, he is investing $6,000 into his portfolio. And in his notes here, Colin says, "Hey Ryan, I am 37 years old and never really got into dividend investing until about 3 years ago. I'm fortunate to run a fairly successful business, which has allowed me to lump sum invest at various periods of time. Originally, my portfolio was focused more on high dividends. However, in the last 2 years, I switched to high growth / high dividend growth since I don't believe the amount invested is going to be an issue. So the growth of the portfolio and dividends is more important. The Southwest Airlines and General Mills positions are inherited from my late father's account, which is why they don't really fit into the mix. However, everything else is intentional as a dividend growth strategy. My ultimate goal is to create a portfolio which will have an insane annual dividend amount, which I can roll into an irrevocable trust to set up my family for generations to come." Man, so first and foremost, I am really sorry to hear about your dad no longer being around. That's really tough. But as far as your portfolio goes, I've got to say that I'm jealous of your portfolio would be a huge understatement. Taking a look under the hood, guys, we can see that Colin's portfolio is valued at an insane $3.2 million. Look at that, guys. From what I can remember, this is the first 7-figure portfolio we've looked at so far in this video series, which is very cool. This is a whopper. Now, of this $3.2 million, 661, almost 662,000 of it is pure profit, guys. Just capital appreciation in dividends. And just today, with a 0.7% gain, it looks like Colin is up $22,000. Holy cow. I couldn't even imagine, guys. I daydream about having a portfolio like this. I'll just leave it at that. And looking at the dividend stats, these are coming in pretty modest. I will say we have a relatively lower starting yield at about 1.5%, but there's a very nice dividend growth rate here. On average, the dividends are increasing by about 8%. And with the stats as they are right here, Colin is bringing in $48,300 in dividends every single year. So obviously some very impressive numbers across the board here. And as we'll see in just a moment, the holdings in this portfolio are very solid as well. Real quick though, I wanted to mention that Colin has shared his portfolio with us here using Snowball Analytics, which is actually the sponsor of today's video. This is a really cool portfolio tracker that I think you guys would like using a lot, and they're actually running a killer sale right now, and I want to tell you a little bit more about it. One of the most essential tools for any investor is a solid portfolio tracker, and Snowball Analytics is like the Swiss Army knife of portfolio trackers. I've been using this platform pretty religiously to track my own portfolio for a while now, and I can't tell you how impressed I am with how much insight it provides into my portfolio. As you can see, the layout is very clean and intuitive, and the platform overall is pretty easy to navigate. Plus, it's packed with more charts and graphs than you can count, which speaks to just how much data you get, not only for your portfolio, but also at the individual stock level as well. I mean, pretty much anything you want to know about a company's financials or dividend history can be found here within the platform. Now, in my opinion, what really sets Snowball Analytics apart are the features it has specifically designed for dividend investors. I'm actually convinced this platform was made for us, and here are some of my favorite features. First off, Snowball tells you your total returns by default throughout the platform, which may sound like a small thing, but it's crucial for dividend investors because it doesn't neglect the dividend income we receive when calculating returns. Most other portfolio trackers will only show your share price returns, which is really only half the equation, so it's refreshing to see dividends factored into these calculations. Additionally, Snowball has a pretty in-depth event calendar that keeps you updated with upcoming news, dividend payments, and any other important stuff going on. And they even have a dedicated dividend calendar so you can see who's paying you each month, when they're paying, and how much they're paying. Beyond these tools, Snowball also has a community section where you can check out other users' public portfolios to see what others are investing investing in, which is always a fun thing to look at. Plus, they have stats for stocks and ETFs that show what's trending and what's popular among other investors. This makes Snowball not just a killer portfolio tracker, but also a great place for dividend investors to get new investing ideas. So overall, if you're looking for a great portfolio tracker, which once again is something that every investor needs, then I highly recommend you check out Snowball Analytics, which you can actually do for free. All you need to do is click the link in the description of the video or in the pinned comment, or just scan this QR code right here to get a 14-day free trial. And if you like it, you can save 30% on your subscription right now until May 21st. So time is definitely of the essence. I really love using Snowball Analytics, guys, and I know you will too. So definitely take advantage of this sale and save 30% on your subscription. All right, guys, now getting back to it and taking a look at all of the holdings in Colin's portfolio here, there are in total 14 different holdings, with the only ETF being SCHD right here, the holy grail of dividend ETFs. And SCHD makes up about 16.3% of the total portfolio, which means that the remaining 83.7% or so is in individual companies, with, as we can see here, just the top 4 positions, including SCHD, making up almost 70% of the total portfolio, which on one hand, I will say does give me a bit of pause, because that is a lot of money, multiple millions of dollars concentrated in just a few different places. But then again, on the other hand, a lot of that is in an ETF, 20,000 shares of SCHD, so that definitely helps on the diversification side of things. And the rest of that is invested in some of the bluest of the big blue chip companies out there, and all 3 of these are still growing pretty aggressively and also very consistently. So all of that is to say, overall, I think that's fine. I think there's plenty of worse places you could be parking your money besides Alphabet and Amazon and Microsoft. And then getting into the rest of the holdings here, we'll recognize all of these guys: Google, American Express, ADP, United Health Group, which, as we can see here, Colin is still seeing a very nice gain despite the crazy pullback that UNH has seen. He's still up 46.3%. And then also Target, I'm guessing this is probably a relatively new position for you, with your average cost being just under $93 per share. So great job, already up 5.4%. You timed that one nice and locked in your 5% dividend yield. And then this one right here, I will say, is probably the only one that I'm not all too familiar with. I maybe have heard of this company once or twice before, but they do look to be a pretty decent dividend payer. And my goodness, look at that yield on cost, 8.6%. And you've done really well with this position too. And so overall, I think this is a great looking portfolio. I really don't have anything bad to say about it. I mean, you're up on pretty much every single position with the exception of SCHD, interestingly enough. So how could I complain? However, with that said, if you were trying to maximize the dividend income and the dividend growth in this portfolio, there are a couple changes that I think you could make that would maybe be a bit beneficial toward reaching that goal. First of all, I would maybe consider selling out of JXN and even Duke Energy right here, which you've also done very well with, up 163%. And like I mentioned a moment ago, you have a very killer yield on cost with JXN. You also have an even better yield on cost with Duke, almost 9.5%. But these are both pretty small positions for you. I mean, 1.2% with Duke Energy, less than 3% here with JXN. And so I think these could be pretty easy ones to let go of, and now may not be a bad time to lock in some gains and put those profits to work elsewhere. I think that by selling out of these 2 holdings right here, you could reallocate those funds to SCHD, which, as we can see here, has a higher dividend yield than both JXN and Duke Energy, coming in just below 4%, and the dividend growth rate is way better than both those two, almost 11.5% on average over the last 5 years, which means that by making this move, not only would you be able to generate more dividend income today, but that income would grow at a faster rate over time. So it checks, I think, both of the boxes that you're looking to check. With all of that said, though, even if you didn't change a single thing in this portfolio, I think it's looking great. And I can't wait to be at this level, having that much invested. I bet that's a really cool feeling. But anyway, Colin, my friend, thank you so much for letting me check out your portfolio. It's really cool to see what you've got going on under the hood here, and keep up the great work. Now guys, moving on to portfolio number 2. This one belongs to my friend Ryne, who, like Colin a moment ago, has been investing for somewhere between 1 and 5 years, and also has a relatively long time horizon, hoping to live off dividends sometime in the next 2 to 3 decades. And every single month, Brian says the amount that he invests can vary because he has a recurring $120 investment every month, but he says, if I see something good, I can splurge a little. Now in his notes here, Brian says, I'm a first-year medical student investing in tiny amounts at the moment, but I wanted to get started as early as I could. I've been looking into riskier sectors like the uranium market. He says, I think this will be the future of energy with nuclear energy and all developing exponentially. But he says, I've been looking into stocks here that also have high dividend yields. Any advice or comments in general would help a lot. So I really don't have much to offer in terms of the uranium market. I'd be much better off trying to teach you French, which I don't know a lick of. But generally speaking, I can't say that I'm a fan of actively seeking out more risk. If anything, I think it makes sense to minimize the amount of risk you expose yourself to, especially as someone who's kind of just getting started with all of this stuff. But anyway, let's take a look at the portfolio and just see where things are at. So Ryne has also shared his portfolio with us here using Snowball Analytics, and right now he's got about $5,700 invested, and so far he's doing pretty good. He's seeing almost $600 in profit, up 10.6%, and looking at the dividend stats over here, it looks like Ryne has a relatively high starting yield here at 6.5% with a 2.2% average dividend growth rate. Now, right off the bat, one of the first things that I will say is if you're not planning on using your dividends for another couple of years, then I think it makes sense to work on increasing your dividend growth rate above this 2.2%, which, yes, in doing so, in buying things that will increase your dividend growth rate, that's likely going to result in a lower starting dividend yield. But I think that is a totally fine trade-off. You have so much time on your side to let dividend growth and the snowball effect do a lot of that heavy lifting for you. So the way I see it, when all is said and done, after a couple of decades of just letting it do its thing, you'll probably end up with more dividend income and faster growing dividend income than if you were to maintain a higher starting yield with a lower dividend growth rate across those same couple of decades. But anyway, looking at all of Ryne's holdings here, we can see that there are only 5 different positions in this portfolio, which is something that I actually appreciate. Sometimes, guys, when we look at these portfolios from people who are kind of just getting going, maybe have a few $1,000s invested, it's not uncommon to see 20 or 30 different stocks in this portfolio. New investors really have a tendency to load the boat with a ton of different positions. That was something that I was very guilty of myself when I first got into investing, but I don't think it's the way to go. So I'm very happy to see Ryne have a more concentrated number of holdings. Furthermore, I'm even more happy to know that like 56% of Ryne's portfolio is an ETF. So we have SCHD and we also have a JEPQ right here. And then we've got these 3 individual companies. And looking at each of these holdings on their own, I think most of these are pretty fine here. I mean, obviously, I'm a big fan of SCHD. I'm a fan of Realty Income. I'm a fan of KRC. I have all 3 of these in my portfolio. And even though I'm personally not much of a covered call ETF guy, I think JEPQ is fine. I think if you're going to buy covered call ETFs, JEPQ and JEPI are 2 of the better ones that you can buy. However, with that said, I really don't like Kraft Heinz. I don't like KHC. I do think it is a simple business. It's a very straightforward one. And it's not a complicated business by any means, which is great. That's one thing that I like about it. But from a financial standpoint, I just don't think this is a great business. And looking at the Snap score, we can see it has it here below average, 3.3 out of 10, and it is scoring low in pretty much every department, with the highest score only being a 5 out of 10 here in profitability. And scrolling down just a little bit, taking a closer look at some of the financials, looking at the revenue, earnings per share, and free cash flow per share, there's really nothing exciting about this. And starting with the revenue, it's more or less stagnated across the last decade. And over the last 5 years, it actually has a negative growth rate by 0.3%. So that's no bueno. And then here in the earnings per share, I don't really see any discernible trend upward. And even prior to the pandemic years, the earnings weren't looking that good. And then I would say the same is true here looking at the free cash flow per share. From what I can tell, there's really not much of a growth trajectory here. It's really all over the place. And scrolling down even more, looking at the dividend stats, that stagnation has certainly trickled down here to the dividend. With that said, the yield is very high right now. You can lock in a 5.8% yield. And while I do understand the draw to a yield that high, that seems to be the only redeeming quality of the company, at least from what I can see. And, at the end of the day, that's not enough to invest in a company. You've got to look beyond just the dividend yield. But anyway, going back to the full portfolio, like I said, I really don't have anything against owning any of these other holdings here, but I would love to see a higher priority placed on dividend growth, which for us here means just putting more money into SCHD. Even though it is about 33% of the portfolio already, I would love to see SCHD be more like 60 to 70% of the portfolio. And I think if you were to increase the weighting of it by that much, basically double it, maybe even more than double it, I think that will create a much better balance between dividend yield and dividend growth, considering all of the other holdings in here The other 4, assuming that you hold on to Kraft Heinz, those are all high-yielding investments. Beyond that, though, the only other thing that I think is potentially missing here is maybe some sort of S&P 500 fund, but that's not, necessarily mandatory. The only thing it'll add is some more broad market diversification, which may not be a bad thing, and it will also add the potential for more capital appreciation, which definitely will not be a bad thing. But those things may or may not be important to you. I don't know. At any rate, Ryne, thank you so much for giving me the opportunity to review your portfolio. I think you're off to a great start, so keep up the good work. All right, my friends, now moving on to our third portfolio of the day. This one belongs to my friend Matt, who, like the last two fellas, has been investing for somewhere between 1 and 5 years and also doesn't plan on living off dividends for another 2 to 3 decades. And Matt's hitting his contributions really hard. Every single month, he's investing $2,000 into his portfolio. And in his notes here, he says VFIAX and VTI are both in my traditional and Roth IRAs, and the rest are in my brokerage account. It might look like everything is in one account, but I put everything in my portfolio on one spreadsheet for simplicity purposes. All right, so that's good to know. And just jumping right into Matt's portfolio, he has shared it with us here using my dividend portfolio tracking spreadsheet, which you can start using for free. There is a link to download this spreadsheet in the description of the video. But Matt's portfolio is looking really good. He's got about $175,000 in here, and so far he's seeing some really nice returns. On a total return basis, he's up over $30,000. That's including dividends. And these dividend stats, I think, are looking decently well balanced, a 1.8% starting yield with about a 6.5% dividend growth rate. That's not too shabby. And every single year, he's bringing in $3,100 of dividends, which breaks down to almost $260 on average every single month. Great job. Now, taking a look at all of Matt's positions here, there are 24 in total, 3 of which are mutual funds or ETFs. VFIAX right here, we have VTI, and we have SCHD, which, as we'll see in just a moment, make up the bulk of this portfolio. In total, these 3 make up 73% of the thing, with the other 27% in the rest of these individual companies right here. And just scanning all of these different companies, we should recognize a lot of these guys: AbbVie, ADP, Broadcom, Chevron, Alphabet, I mean, all the way down. I don't need to list them all. I think you guys will have heard of every single one of these stocks. And on their own, I think all of these companies are pretty solid companies. There isn't one that I'm looking at here thinking, these are too risky, or, these are a poor investment. I think, Matt, you've done a great job picking the companies. With that in mind, though, I do see a lot of small positions in this portfolio. I mean, there are 1, 2, 3, 4, 5, 6, 7, 8, 9 positions that have less than a 1% weighting here in this portfolio. And these 9 positions combined only make up 7% of your portfolio. So with that said, I do think there is some room to consolidate here. I think a lot of these positions, less than 1%, are not going to move the needle for you, even though they are good companies, unless you're actively building up any of these positions, which, remembering some of our conversations, I think you are. I think, and correct me if I'm wrong, Matt, I know you're watching, you might still be buying Zoetis. You might be buying Pepsi. I don't remember if that's one of them or not. Chevron, I think I kind of remember you maybe buying Chevron. But generally speaking, when it comes to these small holdings, I think you could build more meaningful positions with a lesser number of holdings. And since you're already so diversified in these funds, whether it's VFIAX, VTI, or SCHD, which once again, when combined, already make up 73% of your portfolio. But since you're already so diversified within those funds and throughout the rest of your portfolio, I think you'll survive with a lesser number of holdings. And I think that streamline will actually be a good thing for you. So if I were to change anything about this portfolio, it would just be that, just streamline and simplify things a little bit. But with that said, what makes this tricky, what makes consolidating tricky in this portfolio is that all of these are solid companies. So I understand if it's hard to want to get rid of any of them. Other than that though, Matt, you are absolutely crushing it, man. 200K coming up around the bend for you. That's really good. So keep up the good work, and thanks for letting me review your portfolio. Anyway, guys, those were our 3 portfolio reviews of the day. And if you want to take a look inside my portfolio and see how much money I've made with dividend investing so far, then check out this next video right over here. I've been investing for about 5 years now, and in this video, I'm breaking down the performance of my portfolio along with all of the dividends I've received so far. So click right over here to check that out, and I'll see you in the next one.